All right, so we are looking at 6.2 section here. We're going to be talking about adjusting entries. Adjusting entries will be the next two columns of debits and credits after the trial balance, which we completed in 6.1. And so we got to figure out the adjustments to two accounts, supplies and then prepaid insurance. And what we'll do is if we'll take and figure out if we've used any supplies during the month, we need to account for them. And so we're going to talk about that. If we used insurance, we're going to account for them. It's called matching expenses with revenue. And so then we need to give updated balances because we're trying to make responsible financial decisions based on our recommendations as accountants, as financial advisors, and we see you need to give them the appropriate up-to-date supplies and insurance. And so that's what we're doing. We're updating supplies and insurance accounts. And so we will start to use two accounts that we've never done before, supplies expense and prepaid expense, or prepaid insurance expense. So we will complete the adjustments column after we make these adjustments to supplies and prepaid insurance. So like anything, I would strongly encourage you to read this section. There's not much you can skip over. I'm going to hit the high notes of it. But basically what we're talking about during our fiscal period that we're reporting, and we said Delgado, you do yearly fiscal periods and then monthly fiscal periods. And so during this month, we buy supplies and we use supplies. We have insurance and we use insurance. And so when we go to the next fiscal period, we want to have accurate, updated account balances for both supplies and prepaid insurance. Okay. Cash paid for an expense in one fiscal period that's not used later period is called the prepaid expense. We were going to have a prepaid expense. And so that's okay. And this is just part of the business. This isn't bad or good. This is just something we need to do. So some of the supplies are used in January, but some are not used until February, March. You have a supplies closet, supplies area, whatever the case may be. All right, and so this matching expenses with revenue is the concept where we will, all the money that we make during this fiscal period, we will also record all the expenses that helped us make this money. So we match all our revenue with all of our expenses. So how do we make this money? Well, we use some of those supplies. We were covered by insurance. So those things helped us make this revenue. So we need to match expenses with revenue. So our accounts should show the use of these supplies, the use of this insurance. Okay. One of the things they get into is the two different types of accounting theories: accrual-based accounting, which is what we're going to be doing. There's also cash-based accounting. Basically, what we're talking about with this is minor. It's all about timing, when you decide to report something. Reporting income when it is earned and expenses when they occurred is called accrual-based accounting. So in other words, if I go into your store and I buy supplies on account, you're recording that transaction. And you're saying that, yes, I am putting this down now. Whereas if we did cash-based, you only record it when cash is received. Okay, there's this concept called materiality, where it says it only matters if it's a small amount of money. But how do you tell that? Because for some companies, $2,000 is nothing, and for other companies, $2,000 is a great deal of money. And so that used to be kind of an unwritten rule. But basically, the difference between the two is timing, when you're going to record it, based on if you record it when it happened or only when you received the cash. And so what we're worried about, and you really don't need to, other than it's going to be on those two definitions will be on the test, is we are using accrual-based accounting. You can read through this. Again, it talks about how the difference is timing. But here's what we're talking about. So we're going to have two adjustments in this worksheet. Supplies is going to be adjusted, and we will use an expense account that relates to it called supplies expense. Okay, the supplies on hand are value items of the value owned by the business until the supplies are used. Okay, we can't record every time we use a pencil. right? So that's why it says it's not practical. So at the end of the month, so we're using January as our example, at the end of January 31st, the balance of our asset account supplies until we make the adjustments is all the supplies we bought that we haven't used. It's all everything we own, supplies wise. And so what we want to do is we want to deduct from this big amount whatever we used. And we're going to make an adjusting entry where we will debit supplies expense and we will credit supplies for what we used. We will do the same for insurance. The amount of insurance premium used during the fiscal period is going to be considered an expense. Again, we're matching our expenses with revenue. So all the money we made that month, how did we make it? Well, we were insured also. Doesn't say, it's not like it's a hammer or a nail, or it's how we made it. You know what I mean? But it is part of our business expenses. And so, excuse me, just like the recording every time we use a supply, we're not going to record each day divide the premium out. So at the end of the fiscal period, the amount of insurance there is represents all the insurance we have. So we have to make an adjustment to show that month's insurance has been used. And so we will use an account insurance expense, and we will debit insurance expense, and we will credit and lower the asset premium prepaid insurance, just like we are going to debit the supplies expense account and credit the asset supplies. These changes that we keep talking about are going to be considered and are considered adjustments. We're making changes recorded on the worksheet to update general ledger accounts. Okay, we are matching expenses with revenue. So all the money we make, we need to match how much expenses we had in order to make that. All right, the worksheet is used to plan adjustments. Changes are not made in the general ledger accounts until we actually journalize these. So first we're going to do the worksheet, then we'll journalize these adjusting entries. So right now this worksheet is a planning tool. We're going to record these adjustments, but we will not post anything into the general ledger accounts and update it until we journalize those transactions later. All right. So we have the trial balance section, and again, this little white line represents, the rest of the ledger. They're just cutting it out so you can see. So we have the supplies and the assets, section up top, and then we have supplies expense down here in the 500s. So supplies expense doesn't have any number, if you recall from the trial balance. Supplies at $620 debit here. Okay, and so that's what they're telling us here. The balance of supplies was $620, nothing in supplies expense. But then we find out at the end of the month, we go through and there's periodic and perpetual. We can get into that in advanced accounting. Methods of inventory to find out how much supplies we actually have. But we figure out, we either estimate or count through and give a guess, and we figure out that the value of supplies still unused is $90. So that is going to be considered what's called supplies on hand. So we thought we had $620, but at the end of the month, Mr. Delgado counts all the supplies and finds out the supplies he has on hand are $90. So we have to adjust the supplies. We can't say we have $620, we actually have $90. So we subtract the two and we find out we use $530 worth of supplies. They give you a 4-question step. What is the balance? What should the balance be? What should be done? So if the balance was $620, but it is $90, what should be done? We need to lower or decrease supplies by $530 because we used, of the $620, we used $530. How do we make an asset smaller? We credit it and we debit it in our new account, supplies expense. And so that's what they're telling you here. Supplies expense is debited. We have these little A's by it because when we used to write adjustments on our worksheet, we would label them so you can tell them easier with A's, and the A's go together. The B's go together, and so on and so forth. So we have adjustment, debit supplies expense, credit the asset supplies. This is the new balance, $90. that represents what we actually have. Okay? You can see that you'll put the debit in the adjustments column next to supplies expense in the adjustments, not in the trial balance. And then we will credit, and that's those A's I was talking about. You guys won't have to do anything with. And again, this is all under the accounting concept, matching expenses with revenue. All the money we made this month, we got to update these assets. We can't go in the next month thinking we have 620 when we really only have 90. Because then we got to buy new stuff, and so we just have to make sure we account for it. Talks about it down here. Okay, so that's supplies. Now we will do the same thing for insurance. You see insurance in the trial balance. We have insurance expense is also another account that didn't have a number in its debit or credit. This line is just showing you there's a difference between the assets and the expenses here. Those are all the 200, 300, and 400 accounts. So at the end of the month, before adjustments are made, we think the value of insurance is $900, and the value of insurance expense is zero because we just started this company and we haven't made any adjustments. So this says we have $900 of worth of insurance, but at the end of the month, Mr. Delgado checks and finds out, all right, yeah, each month is going to take off a certain amount of money, and we really only have $750 worth of insurance left. So we started the balance at the beginning of the last day of the month. When we looked at it, the balance was 900. We realized that we only have this much remaining going into next month, and so we need to show how much we used, and that's always a key phrase. What we used is the adjustment. So if you had 900, you did have 900. You really only have 750. We used 150. And again, you go through the questions if you want. What is the balance of the account? 900. What is it supposed to be? 750. So that needs to be done to correct it? We need to lower the asset prepaid insurance by 150. How do you lower an asset? You credit the asset, you debit the new account insurance expense. So it tells you again, following the matching expense of revenue concept, that we are debiting the insurance expense, which goes along with expenses, debit, normal balance. Again, you see the B that goes with it, and we are lowering the asset prepaid insurance with a credit here for 150. That gives us a new balance of $750, which is what we should be going into the next fiscal period with. We can't go in the next fiscal period thinking we have 900. We have to go in with what we actually have, 750. And so we make the adjustment, and you see it up here. The insurance expense, make sure you're in the adjustments column and not in the trial balance. The insurance expense is debited, and prepaid insurance is credited. And this is what we used during the month. So insurance expense shows what we used during the month. We need to lower what we used from what we had so that we can get an updated balance for that asset. And so on the finished copy, again, we're not showing you a full picture, but you can see supplies, insurance expense, prepaid insurance, supplies expense. None of these two didn't have a balance. These had their original balances. After looking at it, we need to update it, and so we need to say and show these adjustments. Supplies is the A. That $530 is debit to supplies expense, shows how much we used. That's how many supplies we used to make money. Insurance expense and prepaid insurance as a debit to insurance expense for 150, credit to prepaid insurance. That is how much we used during the month. And again, the adjustments, debits, and credits must equal. So we had all those listed in the trial balance to begin with, and then we make these two adjustments in the adjustment columns, debiting the expenses and crediting the assets for how much we used. That should be it.